Welcome to Sam Buys Stocks. I'm Sam, and I buy stocks. Today, after taking a break for a week, I'm back to continue investing. Last week, I focused on well-performing stocks in a few different sectors. Today, we will move from stocks to ETFs, which allows your money to be invested into a large number of companies rather than just one. Before we start investing, let's see where we stand from our last round of investments. Last time, we bought 2 shares of Williams Companies at $32.22 each, 5 shares of Ellington Financial at $17.12 each, and 3 shares of KB Home at $31.10 each. In total, that cost me $68.44, $93.30, and $85.60. The values of these positions are now $70.20, $97.08, and $82.90. This means that we gained money on Williams Companies and KB Home and lost a bit of value on Ellington Financial. We're net positive on all of our investments right now, and we stand to make dividends on our purchases quarterly as well. So it seems like we're doing pretty well with our standings currently. Last time was all about stocks, so today we're going to invest in ETFs. An ETF is similar to a mutual fund, with the primary difference being that you can invest in an ETF on a stock market exchange, much like any other stock. Mutual funds, in contrast, have to be bought into and are not bought into on a stock exchange. Because of the differences in how the two are organized, ETFs and mutual funds operate slightly differently. One big difference is that ETFs are traded all day, whereas mutual funds only trade once a day when the market closes. ETFs are a powerful tool to invest in and should be considered by conventional investors. 2 final things before getting started. First, I'm not a licensed financial advisor, so follow my investment advice with a grain of salt. And second, this week we will be investing $125 and carrying over the remainder of this month's funds into next month's investment pool. So with all that being said, let's talk about what we'll be investing in. The SPDR Portfolio S&P 500 High Dividend ETF is an awesome place to consider investing some of your money. Being a high dividend ETF, you will make good returns on the money you put here. It trades around the mid-$40 range, boasts a 3.5% annual dividend, and invests in many of the major name brand companies you see traded on the S&P 500. iShares is another ETF that pushes for a high annual dividend as well as high asset growth. The majority of the position is in technology, with companies like Microsoft, Apple, and Broadcom all represented in the top 10 investments. Several other high dividend companies are represented in the fund, such as Johnson & Johnson and Procter & Gamble. This ETF pays out around a 2% annual dividend, which is pretty good, given the high performance of the underlying securities. The final ETF I'm investing in is the Columbia Research Enhanced Value ETF. Based on its fact sheet, this fund uses strict rules to determine who and how much to invest into different stocks compared to the Russell 1000 Value Index. But essentially, there are a lot of high-value, high-dividend companies in this fund. This fund has a very low price to get in on at $23 per share. As mentioned previously, I'll be investing $125 this week into these funds, and that's going to come in at 1 share of SPYD at $44.50, 1 share of DGRO at $52.30, and 1 share of REVS at $23 for a total investment of $119.80 for 3 shares total. This is under our $125 budget by $5.80. This leaves us a bit of extra money that we'll be investing next month, which is going to be used well as we pivot to other investments in the future. I've updated the layout of this chart to show the total value of our positions as well as our yearly dividends. As for the dividends, SPDR has a $157 annual dividend, iShares has a $107 annual dividend, and Columbia Research has a $246 annual dividend. This means that, for investing a little bit less than $125, you can expect to make about $5.10 a year in dividends. This is pretty good when you consider that you get a bit more here in terms of stability than you get from the higher dividend from purchasing stocks, which are more volatile in general. This chart shows the relative value of all the positions in my portfolio thus far. You can see that my investment in stocks is roughly double that of my investments in ETFs and mutual funds. Ideally, it would be the opposite, and I'd be more invested in ETFs and mutual funds, which is something that I will address as I continue to add to this portfolio. I'd say that with all things said and done, this investment is a solid B+. It's significantly better than last episode's since it utilizes a variety of different ETFs with high yields, but it probably could be a bit better if more research was done into which fund invests its money where, and it could also be better if there were some value ETFs invested into, in addition to the high yield ones that I focused on this time. Ultimately, I think that this sort of investment is pretty appropriate given my risk tolerance, amount invested, and my demographic. Over time, you would want to have some value ETFs incorporated in with your purchases. Between the last episode and this one, you can see how planting financial seeds can lead to overall portfolio growth. We have already begun to make some good moves with our money, and there's been a little bit of payoff from doing some research and being cautious with our investments. Now that we're making an investment action of a higher overall grade, we could expect some of this to be compounded. This investment should be less volatile than last episode's, yet should return some decent dividends as the value of the ETF climbs upward. If you haven't invested yet, I'd recommend setting aside some money to follow on this investment. I'd also recommend looking at my last video so you can see how I came to this conclusion for my investments. Whatever you do, stay safe, be savvy, and start building some wealth with your money.